Welcome, everybody. I'm going to pass first to Rohan, who's going to open today's session with a karakia.
Te ronga, te tau mai te rāua, te tau mai te oto, te tau mai te waho, te tau ai, te mauri mai, te mauri tū, te mauri ora, te kāpua. Haumi e, hui e.
Kia ora. Welcome, everybody, to Lawyers for Climate Action event. Saying to a few people, we don't actually do too many in-person events, but a number of people have been requesting them. And I thought this is a really good opportunity. So for those of you who don't know me, my name is Jessica, and I have the absolute privilege of being Executive Director here at Lawyers for Climate Action. For those of you who don't know too much about us or what we do, we've been around since 2019. We are a charity, we're an incorporated society of lawyers across Aotearoa, focused on using the law to drive meaningful action on climate change. And probably the most high-profile part of our work is strategic climate litigation. But actually, this is another really important piece of our work, which is bringing people together, bringing together the legal community to talk about and share ways in which we can take action on climate change and help all the various sectors of the economy drive towards a more low emissions future. And I'm very lucky today to be joined by three fantastic speakers. We've got Barry Coates, who is the co-founder and CEO of Mindful Money. We have Katie Beith, who is the head of ESG at Forsyth Barr. And we have Rohan MacMahon, who is a partner at the Climate VC Fund here in Auckland. And before we get into it, I did want to first talk a little bit about how we're going to run today, and then talk about why we've picked this topic. So how we're going to run, got a couple of questions for the panel, which is how we're going to start. I'm going to have an intro question for each of them, allow them to tell you a little bit more about who they are, what they do. Then I've got a series of kind of prepared questions, but this is an interactive session. We had about 45 people registered on the Zoom session alone, so we've got a number of people joining us from across the country. So we're going to have a mixture of questions via Zoom and also questions from the crowd. And so when we get to that point, please do think of questions and feel free to pass them on. So why this topic? Well, the Climate Change Commission has estimated that we need about $34 billion in order to fund the transition in New Zealand to a low emissions economy. And if we are to have a sustainable economy, the question then has to be, well, where on earth is that $34 billion coming from? And one of our views at Lawyers for Climate Action is, well, the government certainly is stepping back from a lot of the financing that we might have wanted to see. We don't have an energy transition strategy, even though that had been planned, or a just transition strategy. There's even a members' bill currently going through the House that contemplates putting fines on companies and banks who want to treat climate as a risk. Which it's not a government bill, it's a members' bill, but it's a pretty remarkable one that we think actually will act as a blocker to the kind of investment that our economy needs. So in that context, what do we do? And our view is that the financial system is continuing to move forward, that private capital is continuing to move forward. And what can we do to help make it move forward faster? Are there legal blockers? Are there legal enablers? And when the government steps back, we actually need private markets to step forward. So this is the kind of question that we're going to be exploring more today. How can we increase expenditure that helps mitigation? More solar farms, more wind farms. What about adaptation, building infrastructure to withstand changes from climate change? And we're going to dig into this, looking at the macro. Are our legal systems fit for purpose? Are they helping or hindering the channeling of private capital for the transition? To the micro, what can we in this room do to help? What's the role of KiwiSaver? Are there better places to put your KiwiSaver money, and what can we do to actually better unlock the power of KiwiSaver in our economy? To what's happening on the ground, what's happening in boardrooms, what's happening in terms of the so-called ESG backlash. So these are the kinds of questions we're going to be exploring, and thank you so much for joining us. It's awesome that you will come out on your Thursday evening to talk about this. So I'm going to start with Rohan. So Rohan is actually a Lawyers for Climate Action member, trained lawyer, but has spent his career working more in management consultancy and more recently as partner at New Zealand's first and I think only dedicated climate venture capital fund. So looking at funding climate startups in New Zealand. He's a board member of Cleanery, for example. There's some of their products are at the back of this room. And my question for you to kick us off is, what do you think the role of alternative asset classes like venture capital is in the climate transition? And I particularly am interested in reflecting on the fact that I think latest Reserve Bank data suggests that only around 0.18% of our $100 billion of KiwiSaver is invested in private investments. And I thought that was a nice opener for you to reflect on.
Kia ora koutou. That's an excellent opener, really is. Thank you very much, Jessica, and thank you everybody from Lawyers for Climate Action for putting on tonight's event. Really delighted to be here. So we're at Climate Venture Capital Fund, we're essentially clean tech investors. We invest in the so-called venture capital asset class, which is part of a series of asset classes that many people would call alternatives or private asset classes. They're basically forms of investment that sit separately from your listed companies and separately from your bond markets or your debt markets. That's a growing part of the financial landscape for a whole variety of reasons, and I might just dig into some of those for a moment. Some people are finding more capital flowing into private equity these days. Private equity can be used to support energy transition. It can also be used to oppose energy transition. There are people buying coal mines and coal-fired power stations and the like through private equity, but it is a growing asset class. These sorts of alternative asset classes also include private debt, which is essentially debt that's not from a mainstream bank. Also include specific investments in renewables assets, in real estate, other forms of infrastructure like telecommunications. What these things have in common being private is that they're not subject to the whims of the public market. So you're not necessarily hostage to the next quarterly earnings report. So it can allow a more long-term form of investing to recognise that good things do take time. Now, one thing that we can see with the climate crisis is that it's both urgent, but it's also a long-term challenge. We have short-term imperatives and damage that's more apparent to us every day and every week, but we won't solve this tomorrow. We actually have to work together to solve this over a long period of time. So alternative asset classes, such as in real estate, trying to build more green buildings, trying to green up the buildings that we have, infrastructure, trying to build more renewables and to support more electricity transmission, more solar and wind, more geothermal. They're all good things. In our case, venture capital is an area where we could support the new growing parts of the economy that are trying to really provide clean alternatives to those dirty, polluting platforms that unfortunately underpin most of the economy. Sadly, when we look around us, fossil fuels are actually everywhere. They're in most products and services. And I'd just like to give a little riff to Cleanery, if I may. They're a member of Sustainable Business Network where we're hosting tonight's forum. It's a really interesting example of this sort of work, and they're one of our investees, so I'm really proud of their work. It's a very simple proposition. It's cleaning products that clean your kitchen bench or help you to wash your hands. Why should that come with a massive carbon burden and a massive plastic burden? Why not have a model that is all biodegradable, all natural, low emissions and low plastic? That's what Cleanery delivers. And you can buy that in New Zealand supermarkets today, and also, I'm pleased to say, in Australia and in the US as well. So it's a great company. It's a really good example of what we do. So these sorts of asset classes are growing. They're important to energy transition. They're important to climate response. But while they are succeeding, they're not succeeding fast enough.
Thank you, Rohan. I think really interesting way to kick us off. Next question is going to go to Katie, and feel free to introduce yourself. But my understanding is that you've been working in sustainable investment for about 20 years and currently run ESG for Forsyth Barr. You've also been on the advisory board for Impact Investor, also a member of the external reporting panel. And that leads me to my question, which is focused on climate disclosures. So for those of you who aren't familiar, New Zealand became the first country in the world to introduce climate-related disclosures regime. And the point of that is to, A, make companies and directors of companies around the board table discuss and identify climate-related risks and opportunities, and two, to actually try and incentivize the allocation of capital and investment towards low emissions sources. So my question for you is, how effective do you think that has been?
Thanks, Jess. And again, that's a lovely big opening question, which we could also spend all night talking about. But just very quickly to introduce myself, yes, I'm the head of ESG at Forsyth Barr, and I've had a 3-letter acronym in my job title since 2004. It's embarrassingly bad now these days. But anyway, and that was when I was living and working in London, and I was working for an investment manager over there, and I became the SRI, Socially Responsible Investment Officer. And that was really the start of my career. I remember when I moved into that role, I'd already been with them for 4 years, and I moved into that role. And it was right at a time when clients were just starting to ask questions around what do environmental issues mean to investments in our portfolios and social issues. And so I remember on day one of the job, I said to my boss, right, what are we doing? And he just looked at me and he said, it's up to you. And he said, all you need to do is produce 4 quarterly reports a year. And I'm like, on what? And he said, it's totally up to you. And so I just sort of started off researching about issues. At the time, so I started with climate change and sort of went through a raft of issues over time, how supermarkets source through their supply chains, how pharmaceutical companies provide access to medicines in developing world countries. You name it, we sort of covered it over the next wee while. And it was right at a time when I was traveling around Europe, and I was being very influenced by what I was seeing, and I was quite despondent about the state of pollution over there as a young, clean green Kiwi growing up in the 80s with a Keep New Zealand Tidy campaign. But also working for an investment manager in London, where you have the FTSE 100 companies coming through your office quite regularly, talking about their strategies, what they're doing. You get to meet key people. And I can still remember very clearly when we had BP in the office, the CEO talking, and I asked a question around why a leak in the Arctic region had taken so long to be identified and then so long to fix, and it ended up in a huge big messy cleanup that was very costly. And I can still remember the CEO literally jumping in his seat going, oh my God, an investor has asked me an environmental question. And it was at that point in time I was really connecting the dots between being an investor, being owners of companies, asking questions and having an influence that way. And it was sort of really understanding that companies are part of the problem, but they can also be part of the solution. And that was really the start of my journey into this space, and have kept my career here ever since in different guises. Compared to Rowan's hat that he wears, I sort of the large listed equities hat. That's where my real interest is, in what the big companies can do on this agenda. In my day-to-day role at Forsyth Barr, I have 3 hats. One is I write research on the New Zealand companies, the large listed ones that we cover from an equities perspective, and my lens is really about how they're transitioning to a low carbon economy. I help the advisors with clients to really define their values and think about how they can implement in their own personal portfolios. And then I also lead the firm on its own ESG journey. So it's quite a broad role. Back to your question, Jess. The climate disclosure. So yeah, we're sort of nearing the end of year 2 of the climate disclosures, and people are just starting to turn their attention to year 3. And I would say we have seen quite an improvement in the disclosures from year 1 to year 2. There's, I'd say right now we're facing a bit of fatigue around climate disclosures. They've been really burdensome. They've taken a huge amount of effort and resources to get into action. A huge learning curve for organisations. I think the positive side of that is that you've got, it's become a lot more strategic inside organisations. I was actually at an event earlier this week with Air New Zealand, and they were talking about how pre-COVID, sustainability was important, but it was sort of there as an add-on, whereas now, if it's procurement, it's the fuel teams, it's operations, it's the pilots, everyone is thinking about fuel efficiency or climate change in some sort of a guise, and it's really become integrated into their whole business strategy. And I think the disclosures have really ensure that for those hard to abate sectors and those big companies that are quite heavy polluting, that there's a much more strategic approach across the business. I think on the downside, I think we've still got quite a way to go to get the right information out of those disclosures. So they are meant to be written primarily for investors, and I'm still struggling to get the right sort of information that I want out of them. An example, I was talking to the property REITs earlier this week. I'd like to know, how is your asset base shifting to have better sustainability profiles in each of your buildings? Which ones are at climate risk and how are valuations changing? Are tenants paying more for green buildings, and we're just not seeing that sort of information in the disclosures yet, which with my investor lens on is the sort of thing that I'd like to see.
Thank you. I think it's a really interesting answer. So finally, Barry. So Barry's former MP, used to be executive director of Oxfam, and now for a number of years has been running Mindful Money, which is a charity, fairly, let's say, consumer empowerment charity focused on bringing transparency to how the financial system works and where does your money, when you invest it, really go. And my question to you is related to that, because I think most of us in this room will have KiwiSaver investments. So I'm really interested in your comments on the sustainability of KiwiSaver investments in New Zealand, and what are opportunities that, if you're a KiwiSaver holder, also, what should you know? I think a lot of people actually don't know as much as perhaps they should about where their money goes, but what are the real opportunities you see in KiwiSaver? And I'll ask a bigger question about that. That's a pretty big question. I'll ask another question about that later on, but just some initial comments on that would be really interesting.
Thanks, Jessica, and thanks all for coming out. So I didn't realise, Katie, that my story around this stuff also started in the UK. I was working for WWF at the time and ended up on the British government delegation to the US summit, which some of you may remember from 1992, the biggest summit ever at the time, and where the Framework Convention on Climate Change was signed, Convention on Biological Diversity, Agenda 21, etc. And I lived in the UK at the time and did work on kind of ways to take sustainability forward, and had interactions with the group that was starting the Ethical Investment Network in the UK, Social Investment Forum, and which was a really interesting time because local government Agenda 21 was coming up, the Ethical Trading Initiative was coming up, all of these different sustainability related initiatives were starting up. So that kind of led me down the investment path a bit. I then subsequently got bitten by the bug of trying to solve world poverty, and ended up doing that for a couple of decades, and was head of Oxfam New Zealand for 10 years here. But when I left Parliament, I had a big blank sheet of paper, and one side of it was all the things I didn't want to do, and that was full, and the other side was pretty empty, which is what I did want to do. And I had been heavily involved in fair trade, and New Zealand fair trade kind of increased 100-fold over a few years as we kind of mainstreamed it. So my idea was maybe we can mainstream ethical investment, so to try to get it to be wildly popular, so people would invest much more of their money ethically and would switch their money from bad stuff like fossil fuels to the good stuff like renewable energy. And so we did some surveys of the New Zealand public, and we're still doing those surveys. I've now 6 annual surveys, and it showed that there was a huge desire for ethical investment, but there were some barriers. And one of the barriers was there was just no transparency. People had no idea how to invest ethically, and I didn't kind of really give that much credence until I tried to do it myself. And yeah, I've got a Masters in Management from Yale University on finance, and I thought that I would be able to do it really easily, pick an ethical investment fund. It was impossible, absolutely impossible, and I gave up. But I wanted to set up a charity that would provide that information for others so they didn't have to do the research themselves. And so what we do is we go into portfolios of every 407 KiwiSaver funds, And we understand what they invest in, both directly and indirectly through external funds. And then we align that to the things that people in annual surveys say they don't want to invest in. And so you get to see the transparency, and it becomes meaningful because it's related to what these companies actually do. Who's used Mindful Money? Oh, yeah, great. The rest of you should do, because that'll tell you what's the new KiwiSaver. And then you've got some choices. And so being a charity means that we can make it all available for free, no strings, free. And that's been such a good thing to do. It's a really terrible business model. Don't try it. But it's been a good way in doing it. And so really, in terms of what can people do, what we find is if people know where their money is going, then their values are usually such that they will choose to invest ethically. And we found that actually, if you realize that a larger proportion of your money is in things that are contrary to your fundamental values, then sooner or later you'll get around to shifting your funds to one that isn't. And so that's a kind of transparency using a kind of process where we're not telling people what's ethical and what isn't. They have their own values and their own ideas about what's ethical. We're providing the information and the tools for them to do so. And I think that's a good way to do it. But what we see is that there are some sort of countervailing forces that has made this transition a little slower than I had originally imagined. We are making an impact, but perhaps not quite as quickly as I would like. In terms of sort of the switch from fossil fuels into renewables, it's obviously happening internationally. So you saw the news today, more electricity generated from renewable energy than coal, largely thanks to China. And, this transition is happening. Rocky Mountain Institute talks about the S-curves and the speed of change. So we're on two S-curves. One is S-curves of the transition from fossil fuels to renewable, and the other S-curve is climate impacts. And which S-curve is going to win? And we're seeing that both are progressing at a rapid rate. So I think we can discuss it more, but I think the fundamental thing on our side is not only values but economics. Solar is the cheapest form of energy generation by far, and so we see the barriers that are being put up, not only in the US, but other countries around the world against that transition. And that includes the New Zealand government policy.
Well, one of the other things it includes, and I think it's a real bump in the road, is ESG backlash. I think you see reports of that most weeks. So my question is, how real is that in your experience? Is it actually all talk, and the financial sector of businesses really still moving, following investment into renewables, or do you think there is actually a grain of truth? And if so, so what do we do?
Well, the ESG backlash is unfortunately here. Whether there's a grain, we can talk about whether there's a grain of truth in it or not, but yeah, it is here, unfortunately. And so is politicization. I think that in some elements it's a good thing, because what has happened with the use of the term ESG over the last, say, 10 years, it was a relatively niche concept a decade plus ago. And what we saw is a very, very quick uptake of it, so much so that it became normal. Everybody's doing it. In fact, if you talk to any asset manager across the world, whether it's BlackRock, even some of the ones in the US, although they've got quite quiet, but they're still doing a lot of stuff on this. But pretty much everyone will say to you, yes, we look at risks and opportunities associated with climate and other ESG issues and how they affect investments. That's what we do. That's part of our job. So it's been normalized. But what happened in that very quick period of uptake is that everybody jumped on the bandwagon, including some bad actors. Sometimes practices got ahead of organizations, marketing teams got ahead of organizations, and sometimes labels changed, but practices didn't. And we're in this situation now where we've lost trust in the term and in sustainability more generally. And it's now about rebuilding that credibility, and we see this regulation, coming in. And I generally think it's a good thing. It's about lifting the lid, letting the sunshine in, getting clear on what the term means, and creating some standardization and some consistency and understanding on what it is. And that is all a good thing. I guess the challenging bit is that it has been politicized, and even if I think about the climate disclosure standards, which for me we're not quite getting the right thing out of them that we need yet. There are massive burdens in it. It's kind of like a big pendulum. We've swung from one side to the other side, and we're still swinging. We haven't quite settled in the right space. So I expect we'll be a little bit of toing and froing yet. But I think we've lost a bit of sense of reality. We've lost a sense of why we're all doing this. And I think to sort of work through it, we've just got to stick to the numbers, what the numbers are telling us, those facts. Change our terminology. I hardly use the word. Sometimes, depending on the audience I'm speaking to, I might even not use the word climate change. I'll be like, that river that you swam in when you were younger that you can't anymore. Just finding ways to kind of cut through, to really speak about all the issues that we see in the world, whether it's war, whether it's the change to renewable energies, whether it's discrimination, whatever it might be, all of the issues that we're kind of trying to solve for, and just head back to the facts.
Yeah. It's like we'd all like to have a go. I think it's fascinating that you've had a 3-letter acronym in your job title for quite some time. Some of my voluntary work in previous years has been around terms like corporate social responsibility and other CSR, another 3-letter acronym. They do come and go, language changes, and that's okay. But getting caught in an argument about labels and taxonomy when you're actually trying to work on fundamentals is not really very helpful. So let's go back to the fundamentals. Energy transition is happening. Climate change is also happening. Cleaner energy sources are the cheapest available, and we do need more energy. We also need more resilience. Fossil fuel sources are not resilient. They break all the time. Queensland had a power station blow up last year. It's not great. So when you lean into some of those topics around resilience and simply the financials of whether this is a reliable and cost-effective source of energy, you start to have a different conversation. And I saw someone characterize this in something I was reading recently that said it's moving from, so I like their terminology, so I'm going to steal it. They said we're moving from compliance and reputation to profit and resilience. And I think that's really a neat way of saying it, is that if you can tell people that this is more resilient because it's coming from the sun, and the sun is above us and it will be here tomorrow. Tomorrow's fossil fuel delivery from the Middle East may not be. It's a really neat way of saying it. By the way, it also costs less. So it's a pretty neat way of saying it.
So I think it was this week, the Net Zero Banking Alliance folded. So this was started by Mark Carney at the Glasgow Climate Summit. He's gone on to different things, I mean, there's an interesting perspective on that. I must say, being a kind of an old cynic, I sat there during that whole period thinking, gee, isn't it wonderful that banks have really changed and now they're being kind of really responsive on climate change? And I think there was a kind of wild enthusiasm to think that some of the world's biggest corporations had suddenly changed their minds about their priorities, and it wasn't anymore about making as much money as they could. Actually, they cared about the world that they live in. And I think we're probably a little naive and enthusiastic about that one. And I think what's happened is that once these companies have figured out that they actually have to do things in order to give credence to that label of net zero, then actually they've said, nah, too hard. We didn't really believe in that quite as much. And so you know, it's a little unfashionable to be cynical these days, but I am. And so I think also that struck the fund management movement as well, that BlackRock and others actually voted at Exxon's AGM one year to kick out 3 directors because they weren't doing enough on climate change. Subsequently, Exxon still hasn't done much on climate change, but this was the high point of the investment sector saying, well, actually, we can play this really powerful role in changing the world towards climate action. And I think subsequently what we've seen is that BlackRock isn't voting their shares anymore, and neither is State Street or Vanguard or any of the other majors. And so a lot of that power has been lost from the process. But crucially, I don't think it means that the process of assessing climate risk and climate opportunities is any less important or relevant than it ever was. And I think, you know, there was just an article the other day that said the 60 major banks have got $1.2 trillion in loans to fossil fuel companies. And that's kind of GFC kind of territory. And what's going to happen to fossil fuel prices when demand starts to fall, which, of course, the International Energy Agency says it will anytime now. It is kind of pretty close to peaking. We saw during COVID what happened to oil prices. During COVID, oil prices went negative. So oil prices are really responsive to changes in demand. And what's going to happen to that $1.2 trillion of lending once oil prices start declining and production starts declining and companies start getting into trouble? And I think that you know, these are issues where actually the financial stability issues really come into play. And I think for no other reason that ESG has to be taken seriously because of the fundamentals of risk that's associated with unsustainability.
I'd say Lawyers for Climate Action has a healthy dose of cynicism for fossil fuel companies that say they're in the business of getting out of the fossil fuel industry. So you're in good company here. I think this is a really interesting discussion, and Katie, I might pass to you because there is this question: if you are a fossil fuel company and you're bored and you're thinking, well, what are we going to do about the lack of customers for our products moving forward? It's been really interesting. So in the climate-related disclosures setting, there's been an awful lot of backlash from directors at director liability imposed on them in climate-related disclosures. So much so that it looks, I think, quite likely that there will be no director's liability for climate-related disclosures anymore. That's a proposal that's been mooted, and I'd be quite surprised if it doesn't go through. Question is whether that's a good or bad thing, and I think that relates to a bigger governance question. And you work a lot with, as you said, major New Zealand listed companies. I'm interested in your reflections on kind of the discussions happening around a board table and what you think is happening at a board level in terms of ESG and governance.
Yeah, and I think there's certainly there's a lot in that question. So boards, I think, I touched on it briefly at the beginning, how the disclosures have driven this sort of joined up strategic thinking across boards, but it is clear when you read the disclosures. It's certainly clear when you know a board has kind of opened themselves up to this agenda, taken it on board and really embraced scenario analysis as they're required to do so, look out to the future and really kind of open their eyes up to risks and opportunities that they may not have thought about in a longer term period. It's also very clear when you read a report of a company who's just gone, this is not relevant to me. This is a huge waste of time and resources, and I'm just going to do absolute minimum compliance to get over the line and tick that box. Now, and it's really clear when you read them. I think, you know, it does go to a bigger picture around boards, and I have focused quite a lot on board governance just in my general work this year for a variety of reasons, mostly because we've had a couple of very high and far too many very high profile high prominent New Zealand companies just poorly performing over a prolonged period. So we did a bit of a dig into governance and what's going on. But you know what it comes down to is that culture around the table, and the chair has a huge responsibility. And it comes down to the skills around the table. It comes around to the openness and how decisions are made, and the trust that you build, and your relationships with management. There's so many factors at play, I think. But what's really interesting when you look at what's going on around a board table now is that the environment that we're operating in today is very different to what it was 5 years ago, pre-COVID. You know, we have hybrid workings from home, we have climate change as a front of mind thing, we've got AI coming at you very quickly, all sorts of, you know, different skills that you probably need around a board table. And so I think it's actually a very good moment in time to take a look at what traditional corporate governance good practice is. In my view, it's been the same for decades. It might have been tweaked around the edges, but traditional corporate governance is defined, is very well and easily defined in best practice. It's well known, but is it fit for purpose now? And do we have the right mix of skills around the table with a strong chair that enables everyone to bring their different perspectives into the discussion? And that's a really key role for them. And you sort of see it playing out in a number of ways. And with the sorts of things I think that we need to see change around the table is, you know, a board's job is to deliver a strategy and to manage those risks along the way, and to make good decisions around how they spend money. And I just think there's a lot more to it now, when you've got things like climate change and AI and those sorts of things sitting at the table. And you look at a director's in their annual reports, and you'll see that they will have written out the director's skills there, and they might tick all the boxes, and they might say, yes, we've got climate skills, or yes, we have this particular skill, but you don't actually know when that skill was gained. You don't know if it was from a degree 40 years ago, and if they've kept it you know, refreshed over time, and you don't know if they're looking out to the future and thinking about skills on the horizon that they need to bring at the table. But the other bit we mustn't lose sight of is that business acumen and that experience as well, because I think in some of the companies that we've looked at over the last few years, that real business experience is just absolutely crucial to have at the table.
Others have thoughts on that? No, well, I agree with you. Yeah, no, I think that's right.
Just to say, congratulations on the work you're doing. So important for analysis of the internet for people. It's really great to see that, and great that you're putting it out in public domain.
If anyone hasn't seen, so Forsyth Barr, what was the name of the report? To me, it was excellent.
The governance one that we just put out in June was Navigating Changing Winds. So yeah, I'm sure if anyone wants to read it, just get in touch with Jess and we can pass it on for sure.
It did a really kind of good deep dive into, you know, New Zealand companies not performing particularly strongly, New Zealand listed companies not performing particularly strongly. What are the different attributes of our boards and what, you know, potential causes of that? And I think it's a really really interesting paper. And I mean, I think it segues quite nicely into the next question. I mean, I think, you know, 200 New Zealanders a day are moving to Australia. I think we like to do lots of comparisons at the moment to Australia. And a comparison I particularly like is in relation to superannuation and KiwiSaver funds. Why might someone interested in climate be interested in that? Well, KiwiSaver superannuation funds in Australia are deployed so much more effectively in terms of investing for the transition. You might be surprised, Australia is an extractive economy, but I think that the way in which they're deploying their superannuation funds is so much more effective. Some stats for you. 2% of our around $100 billion of KiwiSaver funds are invested in unlisted shares, compared to 18% of Australian super funds invested in private assets. Startups in Australia receive about 6 times as much private capital on a per capita basis than New Zealand. So I think there's real questions about why is it that Australia's capital markets are so much more effective than New Zealand's capital markets when thinking about how we get our capital going in a low emissions future.
I'm really interested in your views on that.
Sure, Barry, I'll have views on this as well, but I mean, there's a few aspects to that. The Australian superannuation schemes have been running for quite a lot longer, and they capture more capital from everybody's income. So it's a much larger pool of capital. Having said that, they're also allocating more of that capital to private assets, including startups and technology firms and clean energy. So you've got kind of a multiplier effect there. You've got a larger pool of capital and a larger proportion of that capital going into these sorts of spaces. So you end up with a lot more money. My calculation was that the average, if you compare the average Australian superannuation account holder and the average KiwiSaver account holder, I think about the Aussie side is investing about 40 times more capital into these sorts of spaces than the average KiwiSaver. So it's not even close, right? And I'm sorry, I'm the Australian in the room, right? So this is probably something I should apologise for in some way. But the people move to Australia for all sorts of reasons. We have a relatively tradable economy and labour, which is probably no bad thing. So people can vote with their feet. But the more progressive settings around superannuation in Australia have driven Australia now to be the fifth, or in some cases, I think some measures, I think I've seen the fourth largest capital market in the world. So there is a lot of capital in Australia that is now looking to be allocated to all sorts of things. And it's buying electricity lines companies here in New Zealand. It's buying telco firms here in New Zealand and so forth. So that's that part of that private asset sort of settings that I was referring to earlier. It's important that we kind of grapple with that journey. Barry's organisation has been part of a number of people that have been asking the FMA for some clarity on that, which hasn't arrived yet, as far as I've seen. As someone who's in this investment space, I find it rather perverse. There's a cohort of KiwiSavers who invest in these asset classes all the time and think it's pretty normal. There's another cohort that says that it's almost forbidden and that they'll get in a lot of trouble if they do it. And I'm like, well, one of those two things can't be right. They can't be both right. So if the FMA could just clarify that, that would be very sensible. There's also a wider investment trend here, going back to what I said earlier about private asset classes, where more of your kind of overall pension funds are going into so-called passive or indexed assets. So many of you would be familiar with ETFs, exchange-traded funds. The BlackRocks of the world are often very passive investors where they say, let's just buy the NASDAQ rather than saying we're buying a particular stock. Let's just invest in an index that will give you an index effect. And that brings down the fee that you're paying to get exposure to those assets. What then a lot of investors also do is they say, well, where that doesn't apply for the other parts of our portfolio, let's do some bespoke things which we think are more impactful, which derive higher returns, which give us a more fit with our values. And that might be local investment in your own economy. It might be things that are climate friendly or the like. That's what I'm seeing elsewhere. I'm just not seeing quite enough of that around here at the moment.
So just over a year ago, we did some research on the mainstreaming of investment in positive outcomes and positive impact. And the idea was that we saw the data, how little is going into private capital, but also how little is going into companies that intentionally invest for positive impact, compared to what's happening internationally, which is far more. So not only renewable energy, but of course, social housing and all the other things. And it came up with three things. Firstly, there are some requirements under KiwiSaver legislation that everyone's money should be available like tomorrow. It's not quite tomorrow, but immediately. And it means that liquidity management for KiwiSaver providers is a little bit complex for them to invest in private capital, which is typically not available on immediate call. In fact, may not be available for 5 or 10 years. So there's that liquidity management issue. A second issue that you referred to, Rohan, was cost. There's been so much push in New Zealand to say, go for the fund with the lowest fees. So, investing in private capital is not the lowest fees. You're investing in ETFs or indexes is the lowest fees. And the difference is large. And so if you've got a prevailing culture that says, oh, well, they're all the same, just invest for the lowest fees, then actually that isn't very helpful in terms of investment managers who are trying to invest in private assets and having to bear additional costs. And I think the third one is a capacity issue. That, as you say, Ron, the Australian investment scene is much larger, much more, much greater depth, much greater experience. And a lot of KiwiSaver managers are used to investing in listed companies and not used to investing in private capital. And it's a different skill set. And it's a different type of investment. So that you get a lot of hesitancy from fund managers and so they crowd into a similar set of listed companies. And we are seeing things change. You're all aware of kind of Generate KiwiSaver that invested in the Salvation Army social housing bond, and then a whole lot of other funds have done so. Pathfinder's investing in renewable energy and social housing and some other things. Simplicity is investing in Simplicity Living, building houses. So you're starting to get some of the leading mainstream KiwiSaver providers that are doing it. And one of the things that Mindful Money is doing this, as well as putting on our website the things that people don't want to invest in, we're putting on the companies that provide positive impact. And so as of early next year, you'll be able to go onto the website and you'll not only see what you want to avoid, you'll see what makes you really enthusiastic as an investor. And so, there's a little statistic in our annual surveys. If people think that their money is doing good in the world, they will save more money and invest more money. And that's particularly for young people and people from lower incomes, which is really interesting in terms of public policy around encouraging saving. I think there has to be consumer demand behind some of this, consumer demand for renewable energy companies, as well as just a push from the fund managers themselves.
It's a really, really good answer. I'm mindful that we've got about 13 minutes left, and so I'm keen to open up to the floor for questions. And should we start with the Zoom question? Molly, do you want to read? No, I'll read that. This is the question from Felicity Roberts, who says, great kōrero, thank you. How should startup folks working in this space on potentially huge impact areas approach making contact with investors looking for these kind of projects? Big impact needs big ideas, and not everyone has access to friends, family, and personal funds able to get brilliant ideas off the ground. What do investors need to see from a team to start a conversation about early team investment?
Thank you, Felicity, for the question. Obviously, Felicity, you should call me. That would be a good start, or hit me up on LinkedIn. Investors are very happy to look at these sorts of opportunities. There's, I think someone made a comment before, maybe you, Jessica, that we're the only fund like this. We're actually not. There's actually others doing this now, which is really, really great. This is a growing space. Shout out to SBN, who released a report called I think it was the Next Wave Barometer a few months ago, which looked at the fact that there is a growing cohort of companies in New Zealand that are doing this sort of work, clean tech, decarbonising the planet, taking out plastics and the like. They're optimistic and they're growing, and they are acquiring capital from people like me. You need a good pitch. You need to understand your economics. You need to understand your competitive environment. Sort of having a great idea, but no idea how you're going to realize it is not going to cut it. Someone said to me recently, ideas are cheap. And I thought, that's such a shame. It'd be great if the idea alone was enough, but you do need a really substantial business proposition behind it that you've really thought through. The capital is out there. The best companies will get the funding. People like me are trying to find more funding to push towards those firms. We've invested in 10 such companies so far, and we're looking for more. So certainly open for that proposition.
Other questions from the room? Anyone have any questions from the room?
And you'll hear me? Yeah. I'm Dr. Morphy, and I'm a Paul. I'm very sorry about it, but I am. And I've been here 6 years. Before coming here, I had a small portfolio of venture capital trusts. And I'd like to ask, and I think some of our panel members will understand the tax relief for those, which are very generous. So you get a lot of tax back if you invest in those. I'd like to ask the panel if they think that the tax incentive, the fact that the tax incentives are absent here makes a difference, and whether one should agitate perhaps for more tax relief for venture capital investments?
I'd be very happy to answer that, and the answer is yes. I compare us with Australia, where I'm from. There is a much more concessional tax arrangement for Australian firms that are doing this sort of work than is available to us over here. I won't go into the details of it, but here we're treated as being part of the mainstream economy, which is not wrong, but in Australia it's treated as the mainstream economy plus something that the government wants to encourage and incentivize. That's not the way it is here. I find it a bit strange that we have the Closer Economic Relations Treaty between Australia and New Zealand. It's been in place for 40 plus years, yet we have completely different tax rules between the two countries. That seems a bit bizarre. We have quite a bit of friction because we invest in Australia and we have Australian investors in our fund. There's quite a bit of friction in that, which just makes no sense. And then the incentive structure is not well aligned here. Obviously, we don't have a capital gains tax structure here, which is another whole conversation, but to promote and support investment in productive assets is something that the tax system should be trying to do.
And it's not just the tax, that's one lever, but I think, we also miss a DFI here, development bank. We miss anyone that can take on the sort of first tranche of risk and, let others crowd in after that once they've sort of, to remove some of the risk out of some of these new investments that you do have. So I think there's a lot more our government could be doing to, support the new businesses coming through.
Yes. One of the takeaways I had from what you said earlier was that it's really obvious when looking at the disclosures that have been made available today, who's got their hearts in it and who's just doing the bare minimum. Is that reflected in that report that you referred to earlier, the changing things? I'm not aware of either. Thank you.
Oh, sure. Not so much in that one, because that was really about, we basically case studied 5 New Zealand companies that have performed poorly, and really with the benefit of hindsight kind of did a deep dive in as to what went wrong and why. So it was really around the board dynamics. But another piece of research I do, which is we do assess, I call it carbon and ESG because I've separated the carbon out of ESG. We do assess how New Zealand companies are performing on and transitioning and progressing over time. And yes, so they get a rating on C, they get a rating on E, they get a rating on S and a rating on G, and you can look down their scorecards, which we've made publicly available, and see where they're doing well and where they've got full points and where they've got none. So it's very kind of easy to see on at least the metrics that we're looking at, like where they're doing well and where they need to improve. And that also is publicly available. So yes, if you're keen to see it, we can pass it on through Jess.
Thank you.
Hi, I'm Matt. I'm technology, law and policy academic at the law school. And I have a question about carrots and sticks. The political economy of climate and sustainability policy is really tough, right? There's often scarce political capital for climate and renewable related policies. Where would the panel sit on policies that are more like carrots? So you could look at the Inflation Reduction Act in the States. That's mostly about subsidies and tax relief, I guess, is an example of that, versus sticks. And I'm thinking about some of the things that we were saying about corporate disclosures, and you seem to be kind of battling uphill all the time when you're talking more about sticks. I know maybe sticks is the wrong framing, but in New Zealand brought back their kind of more ambitious plan, like you talked about BlackRock. Like it seemed very hard to get corporate directors to take on more liability and more responsibility. So fundamentally, given kind of the political economy and scarce political capital for climate-related policies, where do you guys sit on kind of more carrot-oriented policies versus stick-oriented policies?
I trained as an economist once upon a time, and I convert the carrots and sticks into issues of externalities. And the carrots and sticks, I think, should probably align with the costs and benefits to society and the environment from the activities. So if we're talking about EVs, then fine. EVs should get subsidies because that equalizes the playing field between them and cars, which would have fuel taxes. So what's worrying about the current situation is that both the carrots are being taken away and so are the sticks. And so you're ending up with what is nominally a kind of a level playing field, but actually, if you understand externalities, completely unlevel playing field. And I think that's a kind of real fundamental. So I really would encourage kind of both, but actually related to some tangible kind of costs and benefits.
I think what we're sort of seeing as well, because in the absence of carrots and sticks, there's a real need for leadership, and the government has been obvious and directly said that we want companies to pick up the reins here and run with things. They don't want them to rely on us for policy incentives, and they've said that on a number of different things. And I actually do think that companies are starting to do that. In the climate disclosures that I've seen this year, that you have seen companies say, we are stepping into our leadership positions here. And not all for sure, and it's probably only a small number. But I have been heartened in some of the conversations that I've seen, and one that particularly springs to mind is Goodman Property Trust, who set a 1.5 degree aligned net zero target in earlier this year, but actually it was last year, sorry. But it was right when they went to the board with their target, it was right when New Zealand stepped back. So the board was naturally concerned about it. He calls that got them to do a whole lot more work. They came back to the table in a meeting further down the track, and then the board agreed with it, and they agreed to do it. And part of it was, if not us, then who? That was the discussion we're having. So I'm heartened to see some of these discussions go on in our biggest and largest companies. And I hope that we sort of see more momentum build, and as we experience more chaos, I guess. Yeah, because I think we're not getting it from the government at all.
It's a really fascinating, quite a deep question. I think both the carrot and the stick are subject to the 3-year political pendulum, right? So sometimes the pendulum is swinging away, sometimes it's not. And at the moment, the issue from a governmental perspective is that the carrots cost money. The stick is regulatory and it costs paperwork, but the carrot costs money. So it's even harder for a government of this particular political persuasion to go there. Our investment thesis has generally been, at the Climate VC Fund, has been to, in a way, kind of avoid that whole question by saying, if this particular proposition depends on a subsidy, we'd rather not do it. We're looking to invest in better, faster, cheaper, low emissions products and services. And if they require a particular carbon price or a particular regulatory setting, that's a problem, because that setting could change next week. We've seen that over and over again. In Australia, they introduced a carbon price in 2012 and emissions went down. In 2014, they repealed it and emissions went up. It's not a great investment model to say, I hope the government agrees with me, because they may not. And there are people out there who are doing things that are genuinely better, faster, cheaper, low emissions. And so those are the sorts of people that we're looking for. Obviously, it's great if you've got a sympathetic environment around you at a policy and regulatory level. My understanding is that you're more likely to get that from the current government on the stick side, actually, that they're looking for suitable, sympathetic regulatory moves that actually don't cost them a lot and don't cause them a lot of pain, but can be helpful. But if you go in looking for a check, you probably won't get it.
I think we've only got about a minute left, so I'm going to ask for a quick fire last round, which I think is related to what we just said. Government stepping back is obviously enormously unhelpful, and especially we didn't get government's energy transition. Not energy transition, energy plan released last week, and what impact that might be having, private capital investment. My last question is, if you were to click your fingers and see anything change that might help in terms of directing capital towards the transition, what would it be?
I'll go first. More people realizing that there are investable opportunities in this space that actually are accessible to people and are real, are tangible, and are happening today.
I was going to say more investable opportunities in this space. So there we go.
I want to say that something about the flip side where people are faced with how costly continuing along the current pathway is. When I was at WWF, it was always kind of, why can't we just have a really big crisis rather than a million small crises that create no attention at all?
Just because we sort of said similar things, but for me it is like, and what I really missed in the announcement last week was, can we just have a vision of what our future energy state looks like, and then a pathway that we can all work towards to get there?
Wouldn't it be nice? Yeah. Well, look, thank you so much, everybody. No more questions on Zoom. Well, thank you so much, everybody, for joining us. Thank you very, very much to Katie, Rowan, and Barry. We've got a little something to say. Thank you very, very much for joining us. Rowan's going to close us off with a karakia. We've still got more wine and more nibbles, so please do stick around. But thank you again for coming. We hope to do more of these. It's awesome to gather in a room so you can all connect as well. And if you have any questions or want to discuss, please do find me, Molly, our solicitor, who's also here in the room. Jenny, co-founder and chair of our board, is also here in the room, so do feel free to come and chat to any of us about our mahi. But thank you again for joining us. It's been an absolute pleasure.
Kia whakairia, te tapu, kia wā te ai te ara, kia turuki whakataha ai, kia turuki whakataha ai, haumie, huie, taipei. Just a quick translation. Restrictions are moved aside so the pathway is clear to return to everyday activities, or indeed the drinks bar.